Hi, this is Jessica Dunn. We're going to continue our discussion of capital budgeting techniques with a focus on net present value. Net present value is a sophisticated capital budgeting technique. This is the method that is used by most large companies, and it does take into account time value of money. Hands down, net present value is the best criteria for evaluating projects. So net present value is telling you the dollars added to the firm value by accepting a project. So it tells you how much a project is going to increase firm value after taking into account the cost of the financing. So to calculate net present value, it's equal to the present value of the cash inflows minus the initial cost. If your net present value is greater than 0, then you accept the project. If it's less than 0, so negative, you would reject the project. So if net present value is greater than 0, that means that it is adding a positive return to the company after consideration of the cost of capital. So it would increase the wealth of the owners. So let's look at an example here. We have project A that costs $42,000 and returns $14,000 a year for 5 years. Project B costs $45,000, returns $28,000 in the first year, $12,000 the second year, and $10,000 in the final 3 years. So let's calculate its net present value. Now, we've used the net present value technique before, but we've never used it for evaluating projects. So the calculator inputs are going to be something that you have seen before. So to use your net present value function on your calculator, you first have to use your cash flow worksheet. So it's when you push your cash flow worksheet, it's going to ask you what is your cash flow at time period 0. It's a negative $42,000 for project A. If you push enter and the down arrow, it's going to ask you your cash flow at time period 1. And don't forget to push the enter to save. Cash flow at time period 1 is $14,000. Push enter to save and the down arrow. Then it asks you the frequency of that first cash flow. And so with this one, it's really easy because it occurs 5 times. So once you've put that in, you push your net present value button, which is right next to your cash flow button. Push enter down and compute. And you will get, well, your discount rate is 10%, so 10% enter down compute. And it's going to give you $11,071.01 as your net present value. So this project would add $11,000 in value to the company's value. So let's put that into our financial calculators. So we first push the cash flow button. Once you push the cash flow button, you should push second clear work to make sure it's empty. So now we're ready to enter in our cash flows. So this project costs $42,000. So negative sign. Enter to save and the down arrow. Cash flow at time period 1 is $14,000. Enter to save, and we can scroll down and put in a frequency of 5. If you don't like to use frequencies, the default is 1. You would just type in $14,000 5 times. Press the net present value button. Your discount rate here is 10%. Enter, down, compute. $11,071.01. So now let's do the same thing for project B. Project B, push the cash flow button. Cash flow at time period 0 is a negative $45,000. Cash flow at time period 1, $28,000 with a frequency of 1. Cash flow at time period 2 is $12,000 with a frequency of 1. And cash flow at time period 3 is $10,000, and there are 3 $10,000s in a row, so the frequency of that is 3. Push the net present value button, enter in your discount rate of 10%, enter down compute, and solve, and you'll get $10,924.40. So let's work that on our financial calculator. So I'm going to clear everything out, open my cash flow register, second clear work, enter in my cost. This project cost $45,000. Enter down. Cash flow at time period 1, $28,000. Enter down. Frequency of 1, so I skip that one. Cash flow at time period 2 is $12,000. Enter to save. Scroll down. Has a frequency of 1. Cash flow at time period 3 is $10,000. Enter to save. Scroll down. Has a frequency of 3. So I enter. Now I push the net present value button. Enter in my discount rate of 10%. Enter. Down. Compute. $10,924.40. So when evaluating these projects, net present value approach says that A is better than B because it provides a higher return to the company. So the net present value is higher. So if we're going to rank these projects, we would have A and then B. If these projects are independent and we have unlimited capital, we would accept both. If these projects are independent and we have capital rationing, then we would invest in project A, and if we had money left over, we might invest in project B. If these projects are mutually exclusive, we would choose project A because it's better than project B. Now, net present value is the most correct approach. It's the best approach that we have for evaluating projects. You should always go with whatever net present value says. Net present value is very similar to the profitability index, where the higher the profitability index, the better the ranking. So the higher the profitability index, the higher the ranking. So with profitability index, you can take the present value of your cash inflows and divide by the cost. I like to do it a little bit different, and this isn't a way that's taught in your book. Since it's so easy to take net present value, I take the net present value and add back the cost. Now I add back the cost in absolute value terms so that way you don't have to get bogged down in deciding whether it was a positive or negative. Just do the absolute value and then divide by the absolute value of the cost. Now this is not something that's in your textbook, so you'll just have to learn it from the lecture. Now the decision criteria is that if the profitability index is greater than 1, then you accept. If it's less than 1, then you reject. And so if you're going to rank it, the higher the profitability index, the better. So let's work the same example we did a moment ago where we calculated the net present values. So let's calculate the profitability index of project A. Remember I said the profitability index is the net present value plus the absolute value of the cost divided by the absolute value of the cost. So we know with project A the present value is $11,071. We can add back that initial cost of $42,000 and divide by $42,000. So that gives us $53,071 in the numerator, $42,000 in the denominator, and we get 1.26. Let's do the same thing for project B. The net present value was $10,924. The initial cost was $45,000. Divide that by the $45,000 and we get 1.24. So if we're going to rank this, A is better than B. This gives you the exact same answer as net present value, so it's a perfectly fine alternative for evaluating projects. The nice thing about profitability index is that it doesn't get you bogged down by large numbers. Instead, you have nice small numbers that you can rank easily, and you don't get bogged down by looking at $1 million versus $2 million and having all these zeros to deal with. Instead, you have a nice simple number. So 1.26 is better than 1.24, and we would accept project A over project B. If they're mutually exclusive, we only accept A. If they're independent, you would accept A first, and with any money left over, you would accept B. So economic value added is also pretty similar to the net present value method. It determines whether a project earns a pure economic profit, so a profit above and beyond the normal competitive rate of return. So let's look at an example. Remember we said that net present value is the present value of the benefits minus the cost. That was the first definition that we've learned for net present value. So let's look at this project. It costs $1 million up front, but after that it will generate cash inflows of $120,000 a year forever in perpetuity. The firm's cost of capital is 10%. So let's first calculate the net present value. The net present value is the present value of the benefits minus the cost. And so if this project is going to have $120,000 in benefits in perpetuity, remember that the present value of a perpetuity is equal to the cash flow divided by the discount rate. So 120,000 divided by 10% minus the initial cost of 1 million. So 120,000 divided by 10% is 1.2 million. So subtract a million from that and you get 200,000. Now economic value added is going to get you the same answer. It's just going to come about it a different way. So the economic value added per year is what we're going to look at. So if this project costs $1 million and our investors demand a 10% return on their investment, then investors demand 10% times $1 million or $100,000 return on their investment. So the economic value added per year is bringing in 120,000. Investors are demanding 100,000. So it's bringing in $20,000 per year. The present value of this, so the economic value added for the project, is going to be the $20,000 that you earn every year forever. Discount it by your 10% cost of capital because we're finding the present value of this perpetuity, and you get $200,000. So same answer, just two different approaches for getting there.